You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, I want to throw out a save the date for you. On Tuesday, June 21st, OIC will be offering its second webinar summit. The topic for the day will be elections and market volatility. We're very pleased to announce confirmed speakers include Sam Stovall, U.S. equity strategist at S&P Capital IQ, and Jeff Hirsch, author of The Stock Trader's Almanac and market historian. OIC instructors will present, and there will be a panel discussion on implied volatility that I'll personally moderate. A full lineup for sure. That's Tuesday, June 21st, starting around midday. Registration will be available soon at optionseducation.org. That's it for today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Dan Sheridan, longtime CBOE floor trader, founder, and CEO of Sheridan Options Mentoring. Dan, thanks for joining us. Great to have you on today.
Oh, great to be here, Joe. Welcome, everybody. Glad to be here.
This month's theme for OIC is income generation. So we're going to want to get into the covered call, selling puts, credit spreads, things like that. But before we get into that, how about if you tell our listeners about your experiences, both at the CBO and then, also with your mentoring business?
Sure. Yeah. For about, 23 years or so, I was down at the CBOE. I was part of a specialist group with Jan and Pete Najeri and those two guys that have a lot of hair on their head.
We heard of that.
You heard of those guys? Yeah. So I had the pleasure of working with Jan and Pete for many years, and we were a specialist, kind of a lead, I guess you would describe specialists I don't know, more of a lead market maker, kind of the ones responsible in the pit for the festivities down there and dealing with the public. And so being down in the pit and being a specialist, got used to dealing with the public and what types of orders they do, and trading for many years. I enjoyed it. And being in the retail arena now, trying to help basically baby boomers make a little bit of income every month with interest rates so low. That's what I've been doing the last 15 years. And it's been a big help. I'm sure when you talk to retail people also, it's been a big help with the experience, because, they don't understand, how does it work? Why is the market maker taking the opposite side of my trade? And I think we're really able to help them when it comes to execution and maybe the psychology of trading. But really what I do is just focus retail traders on a couple strategies and help them develop the craft. And that's really what this is. It takes a lot of practice. A couple of the strategies Joe's going to be covering today, covered call, credit spreads, but to turn those into a craft involves good risk management and doing these trades over and over and over. There's no magic here if you approach it like a business and a craft, and that's how we try to approach it in our mentoring business.
Well, perfect lead in, Dan. And really, I know this whole idea of income generation is really where you focus, Sheridan Options Mentoring. So really thrilled to have you on. You mentioned the word risk. How about if you start by maybe just for listeners who may be new to covered calls, define covered calls, and then let's take it from the perspective of risk first. Okay,
so as we're talking about a covered call, let's pretend we have XYZ is trading at $100. And a covered call is a strategy that somebody would do on a stock they like, maybe doesn't move up too fast, right? So we're not talking about, the high flyers. We're talking about good, stable stocks, maybe a stock that pays a decent dividend, but we're talking about buying 100 shares of XYZ. Your opinion is, hey, I like the stock over the next year or two, but you're also saying, hey, this stock isn't like a high flyer, like a tech stock that could go up 30% in a year. It might go up 7% in a year. So to get a little extra income, I'm going to sell an out-of-the-money call. So if I'm buying 100 XYZ, if the stock XYZ is at $100, if I buy 100 shares at $100, and then against that, I might sell one XYZ, let's say a May expiration, maybe a 110 call. So the idea is I want some capital appreciation on the stock, but in a stock that maybe doesn't move up at the speed of sound like some of these biotech or tech stocks. I'm going to sell an out-of-the-money call, and hey, I'd like to get my cake and eat it too, a little bit of appreciation on the stock that I bought at $100, and by selling a May 110 call, let's say I sell it at $2, as long as the stock, let's say in the next 30 days, doesn't go over 110, I collect my entire premium of the short call plus my appreciation on the stock. That's the ideal kind of scenario for this covered call, and I think it's one of the more popular strategies in the income arena. It's usually the introductory strategy. Most people that come into and maybe want to looking into mentoring with me or coaching, or if you ask them, what's your experience in the options world? And they'll say, you know what, I've done some covered rights. So that's usually how people get introduced into the options business, is through the strategy of a covered right. Now, real quick, the difference is, here's the problem. I see it. If you talk to somebody, Joe, and they say, I do covered rights in a conservative strategy. It's a very conservative strategy. I agree. I think it's a conservative strategy, but if I ask that same person, would you ever sell like a naked put? Would you ever sell a put, a short put? Oh, no. That's too risky. Well, in this example, if I buy 100 XYZ, 100 shares of XYZ at $100, and I sell a 110 call against it, let's say $2, that strategy is the same as a short put. If I sold the 110 put, it's the same strategy, correct? It's the same. So a short put is synthetically, or it's the same thing. It's like taking, I have the color red, right? Well, is just drawing with a red crayon the same as I'm not an art major, but isn't there two crayons you put together that will give you red, right? I'm sure there is. I don't know which those two are, but whatever. That's the same concept with this covered right, is that it is a short put. So I don't personally look at a covered right as a conservative strategy. It's used in a conservative way by people, but the bottom line is there a lot of risk on the downside? And as Sylvester Stallone would say, absolutely. So as long as you understand that a covered right, buy stock, sell call, is the same thing as a short put, you're in good shape. But again, the idea, I think, where people call it conservative is they're doing it the right way. In other words, they're looking at this strategy as, hey, I like XYZ over the next year or two, right? I like it, more of a long-term thing, and I'm going to do this methodical, every month I'm going to sell a call against the stock. I think that's the right way to approach it. So anyways, sorry for the long-winded explanation there.
No, it made sense, and I appreciate the Philly reference with Sylvester Stallone. Thank you.
Hey, we got to bring in Sylvester, yeah.
So let me then just, why don't you just go through even just a little more black and white? I mean, conceptually, I think listeners have it, but we've got our $100 XYZ stock. We're selling the call at $2, or in essence, selling the put as well. What is the break-even point there? And obviously, then what is the risk? And I think it has to do with, the obligations that we have by, selling options.
Well, and that brings up an interesting point. Maybe we could relate it with the market right now. The market SPX is, as I speak, around 2085, which is pretty high. We're not that far off the all-time highs. If I remember correctly, Joe, correct me if I'm wrong, the all-time highs in the SPX are around 2130.
Yeah, bingo, Dan. And boy, we were a lot lower not long ago. So
right,
exactly right. Yep.
Right. We've been up 14% or so in the SPX in the last month or two. And so, being 50 points off the top, taking this concept of a covered right, your break, if it goes down, your break even is basically what you sold if I sell in this example, the XYZ is at $100. If I sell the XYZ, 110 calls for $2, bottom line is my break even, I've basically got $2, right? I've got $2 of this. The only thing that's helping me on the downside is this $2 I got from the call, right? So, my break even would be, this $100. If I buy the stock at 100, I got a couple bucks on the downside to breathe, right?
Got it. Okay, so
and
you're
that's
talking, yep, 98 break even. But then, getting back to your point about it's a conservative strategy. Below 98, you're flat long the underlying. So that's not necessarily conservative,
right? You're goosed. So to me, with us, at these levels, as we're getting up in the upper end of the range. Again, I'm not saying we can't go higher, but I think if I'm a covered right trader, in other words, I'm in Apple, or I've been in Johnson & Johnson, or some of these good stocks I might like over the next 2 years, and they've been up 15% over the last couple months. Hey, let's be honest. I'd be happy with 15% over the stinking year, right?
In a heartbeat.
And they're up 15% in two months. So I'm not drinking the Kool-Aid, right? I'm still saying, hey, I like Johnson & Johnson. I like, IBM over the next 2 years, but I don't think we're going to be going up 14% every 2 months, right? I just can't drink that kind of Kool-Aid, right? So what I might be doing at this point is saying, hey, you know what? After I sell this May option at the 110 strike in XYZ, if it comes to June and we're still up at these levels and we're not over 110, what I might do, or if we get near 110, and let's say I collect that $2 premium, well, what strike am I going to sell in June? And if SPX is getting close to that 2120 or the all-time highs, I might want a little bit warmer blanket for the downside. Instead of selling maybe an out-of-the-money call, if XYZ goes up to, let's say, 110, right? And I'm thinking, boy, we're up 16% in a month. If XYZ goes up, I might sell a little bit in the money call, right? Or an at the money call. In other words, as we go higher and higher in the market, I might want a little bit more protection. So how do I get protection in a covered right? A little bit more, sell an at the money or slightly in the money call, and I'll get more premium, and that'll give me a little warmer blanket on the downside, and it'll give me a little lower break even. And that's kind of like this it's a breathing, it's a living, breathing organism here. So I'm not always doing the conventional covered right is buy stock, selling out of the money call. But as we go higher and higher, right, and as I'm making more and more money on my stocks, I'm getting a little Chicago or Philadelphia skeptical, right? And I'm saying this can't continue, right? This 14% pace every couple months can't continue. I want a little bit more protection. And so I'd be selling more of an at the money call or slightly in the money for a little bit more protection. That's all. To protect the profits, right? You look at a lot of these stocks, Joe, they've come up nicely the last 2 months, and I'd like to protect a little bit of that.
Makes sense, Dan. So just kind of to paraphrase, I guess there are two approaches. There is the non-living and breathing look at the market approach, where you're going to decide philosophically what strike in terms of at the money or a percentage out of the money to sell systematically along with the time period. So that would be one approach. Or to, as you say, analyze the dynamics of this living and breathing market and decide on which strike price based on recent movements in the market. Is that a fair?
Well, it's correct, because you're not. I mean, let's face it. XYZ is going to move, right? If we buy XYZ at 100, it's not going to sit there for 12 months, right? And so, if I'm selling a call against XYZ every month, it's probably not going to be the same strike every month, because the price is going to move. And so I just think it's a nice thing, even though my opinion, usually when people do covered rights, their opinion's not going to change over the next month. In other words, if you like IBM over the next couple of years, or you like Johnson & Johnson over the next couple of years, it's not going to change. But if the market is, all I'm saying is if the market's up 20% in 2 months, and you look over the last 20 years, we don't usually keep that up, right? And so I would just like a little more protection. So I just wanted to put it out like that. Another thing real quick, Joe, I don't know if this is appropriate here, but I'll just say it real quick. In terms of another thing, when the market gets maybe ahead of itself, has had a good run, and we're up 15. What do I define as a good run? Maybe we're up 15, 16% in a couple months. We don't usually sustain those things, right? As Joe said, we'd be thrilled to be up 15 to 16% in a year. But what I like to do is a covered right eats up a lot of capital, especially if you're doing a covered right in an IRA account, which a lot of people do their trading in a retirement account. You have to basically put up 100% of the stock, right, Joe? So you're paying a lot of capital to do one covered right. Well, what's an alternative? Let's say I want to take some money off the table when a stock is run up a lot. What's a way that I can basically have a similar graph as the covered right, but only a fraction of the capital? So kind of you could, in the stock replacement family, I'd call this a long diagonal. So again, taking XYZ, The original example was buying 100 shares of XYZ at 100, selling one May 110 call, $10 out of the money for $2. I'm going to stick exactly with what I sold. All I'm going to change is, instead of putting a bushel basket full of capital into the long stock, I'm not going to buy the long stock, and I'm going to maybe go out 2 or 3 expirations from the short. So May, we're selling May. So maybe I'll go out to July or August and buy a in-the-money, maybe an 80 delta call as a replacement for the stock. So it would look like this. Buying one, as we said, we're selling one of the XYZ May 110 call. That's the same short call with the covered right, but instead of buying 100 shares of stock, I'm going to buy one, I'm just kind of making this up here, one XYZ August, let's say 80 call, right? And it might be trading at $25 or something like that. The bottom line is you're buying an option that's going to act a lot like stock on the upside, but it's a fraction of the cost. And I would call that, I don't know, Joe, if you guys would call it a different term, I would call it a long diagonal.
I would completely agree, Dan. Long diagonal, exactly. And it's a very good point you raise, far less capital tied up. And the key being, having the discipline to sell those front month options into that further out expiration, to offset any additional time premium that you had to purchase with that 80 delta call. But the long diagonal is another fine approach to income generation, assuming you stick with that discipline of selling the call month after month.
Right, and that's the whole idea here. That's, as Joe said, every month you're going in and selling, and one way to avoid buying too much time premium with your long option is a general guideline, buying a delta of 80, at least 80, because the more in the money an option is, you're going to be buying much less time premium. Your most time premium is going to be in maybe a 50 delta option. So as you go 80, 85 delta, very little time premium.
Excellent. I appreciate you offering that alternative choice. I want to ask you one more thing before we go to credit spreads. And, you're talking about selling the monthly option. I think we have about 600 and change weekly underlyings, that have options that expire once a week for 5 consecutive weeks, a little over 600 of them, I think, in our universe. Do you ever get into the weekly option, or do you strictly stick with the standard monthly option?
Oh, I like the weeklies. It doesn't matter. To me, some people get concerned with the liquidity of weekly options, but to me, if I'm in a liquid vehicle like Apple or Amazon or Netflix or SPY or SPX or Russell, it doesn't bother me. As long as the underlying is very liquid in terms of how many options they trade, I like the weekly options. And what I also think, Joe, is I like to diversify in terms of when I'm putting on, let's say, covered rights. I like to diversify a little bit the duration. In other words, I might sell an option 30 days from expiration, give me a little more premium, but I might also sell an option 8 days from expiration. So again, you can diversify. I think this would be a little more advanced concept, but you can diversify your duration when you sell these trades. And there's nothing wrong with selling if you like to be a 30 days out. It doesn't matter. I mean, I would prefer doing a monthly, but if they didn't have a monthly around 30 days to expiration, I'd have no problem doing the weekly. The weekly that is 30 days from expiration.
Dynamite. Okay. Well, good synopsis, I think, with the covered call, defining the risk, also offering that choice for a long diagonal to tie up less capital. How about if we take a couple minutes to talk about your approach to credit spreads? And
Sure.
Just by the name credit spread, we know we're taking a credit out of the market. Maybe offer a couple of your favorite credit spreads. And of course, let's talk about it from a perspective of risk reward.
Sure. And I think the big thing when you're running, I'll take the perspective of running a credit spread business. right? Instead of, I don't like to take the approach, I'm going to try a credit spread. If it works, fine. If it doesn't, I'll try something else. If that's the case, none of us would do anything, right?
Exactly.
None of us would be playing sports, would we? If we said, well, if I do really well on this, playing basketball the first time, I'll continue, but if I don't, I'll quit. Well, there's always going to be, there's a learning curve. So in terms of doing a credit spread, let's give an example, if that's okay. So again, back to XYZ at 100, what I like to do is, again, it's important if you do a credit spread, let's just take a call credit spread. XYZ is at 100. If we sell one XYZ, let's say 110 call, and we buy one XYZ 115 call, right? We're selling the 110 call, we're buying the 115 call, and I'm going to just make up some prices here. Let's say I sell the 110 call at 2, and I buy the 115 call at $1. Okay? Yep. So XYZ is at 100. I sell one, let's call it May 110 call at $2, buy one May 115 at $1. So I'm selling the credit spread for $1 credit, right? It's out of the money. The short call is out of the money, and as long as we don't go above the short strike between now and at expiration, I collect the entire $1 credit.
Do we own the underlying?
We don't yeah, good point. We don't own the underlying. We just go in and, again, most people are selling credit spreads, and I say selling because we're bringing in a credit, and a lot of them do it for income. A lot of people will, if they think the SPX is going up, they might do an out-of-the-money put credit spread. If I think Apple's going down, I might sell an out-of-the-money call credit spread. But what's nice about these is they're not just directional, they give you probabilities. What do I mean? So, let's talk about the risk. So if I sell this credit spread at $1, I'm selling the 110 call at $2, and I'm buying the 115 at $1. So I'm selling it for $1 credit. The width of my credit spread is 5, the difference between my 110 strike and 115. So I have $500 of risk. If we're over 115, the long strike at expiration, I have $500 of risk. So if XYZ goes to $1 million, what's my risk? My risk is the distance between the strikes, so $500, less my credit of $100 is $400.
Okay.
So I'm bringing in a $100 credit, but if XYZ gets taken over or goes to $1 million, I lose $400. So is it a good risk reward? Well, sometimes. It all depends on how you set it up, but there's like a pendulum there. I can go, let's pretend, right, the 115 call or the 110 call that I'm selling, I'm just going to make this up just for a quick illustration. Let's pretend the 110 call has a delta of 20, right? What does that mean? It means that the probabilities of XYZ going from 100 and closing over 110 in the next, let's say, 25 days till May expiration is 20%. So I have probabilities in my favor. What do I mean? If I'm selling a 110 call with the stock at 100 and the 110 call has a probability or has a delta of 20, it means there's only a 20% probability XYZ is going to finish over 110 by May expiration. So when I'm doing this credit spread, I'm starting out with pretty good statistical probabilities in my favor with the idea if I'm doing this over and over again. So I think I usually pick my short strike of a credit spread by the delta because I want to do a high probability type credit spread. And usually I would go somewhere around a 20 delta.
Okay, that's really, really good information. So
yeah, so there's two things here real quick, Joe, if I can. There's two things. So
Please.
Number one, if I'm going to do a call credit spread at XYZ, my first assumption is, hey, I'm either, neutral, maybe the stock has made a good run up. I don't think we're going over 110, right? Stock's at 100, it's been running up. and I think it's going to back off. So I don't think it's going over 110. So there might be a neutral to maybe a little bit bearish. I put the credit spread on, but by the way I pick my short strike, I'm adding really good probabilities to this trade, right? And so that's kind of why I would put it on. But let me just say the last thing. The most important thing in running a credit spread business, if I'm doing these, assuming I'm, and I like to just maybe pick three stocks, maybe three liquid stocks. So let's say I'm dealing with Apple, Netflix, and Amazon. And I'm going to, every month I put on a credit spread. Sometimes it might be put, sometimes it might be call, but let me just say the most important thing in the credit spread, running a credit spread business. If I'm bringing in $1 credit, and let's just assume for illustration, I'm looking to make that $1 credit. The most important thing is, what do I do in a losing month? How much am I willing to lose? The risk in this case is I'm bringing in $1 to lose $4. Well, if I have a couple months of the year where I lose the $4, the maximum loss on this, my year's shot, right? In other words, it's not a good business model to bring in $1, but in my losing months, I'm going to lose $4. So what I might do is, if I'm selling this for $1 and I have probabilities in my favor, the most I'm willing to lose might be 1.5 to 2 times my credit. So in other words, if I'm selling it for $1 credit, maybe I'll buy it back for $3 if it goes against me and lose $2, right? Because if I'm winning, this type of credit spread where I'm going farther out of the money, like I mentioned, I would do a 20 delta, and I'm making the assumption I'm going to win over time much more than I lose. The key is, what am I going to do when I'm wrong? How much am I going to limit my losers to? And usually in credit spreads, I have a general guideline somewhere 1.5 to 2 times my credit is what I'm willing to lose. So in this case, if I sell it for $1 credit, I'd have an order with my brokerage firm to buy it back. If that credit spread that I sold for $1 gets to 2.5 or $3, I'd buy it back. Why? Because that would be 1.5 to 2 times my credit. I'm only making $1, right? So if I'm only making $1, I can't lose $3, $4 when I lose, right? It's not going to be a good business model. So anyways, I just wanted to bring in that concept of risk. And if you talk to any credit spread trader, if you ever meet by your mailbox a credit spread trader and you say, how you doing? Most of them will say, you know what, I would have had a great year except for that 1 month. And that 1 month I gave away, what I normally make in 1 month, I lost 4 months worth. And that's why, when you look at, we've had 2 10% corrections in the last 7-8 months. So for people doing a lot of people I know, Joe, are doing put credit spreads. Out of the money put credit spreads and the indexes on a regular basis, because most of the last 4 years we've gone one way, we've gone up. But with 2 10% corrections in the last 7-8 months, it really tested people to see, hey, did you have a plan? Did you have a risk management plan on your put credit spread when the market's tanking? What did you do? And that determines a good put credit spread trader. What do you do when it goes against you?
That's just a great discipline and really, I think, a wonderful approach. 2 quick things before we wrap up, just so our listeners are clear, that discipline of shutting down, 1 to 1.5 times once it goes against you is going to be possible the vast majority of the time, with the exception of the case where you have a stock that has some crazy gap to the upside or downside. So that's the one outlier that could blow up that risk management approach, just so our listeners understand that. But the vast majority of the time, that discipline will keep you in the game. And then the other thing I just want to ask you kind of real briefly, Dan, is you're doing the call. Do you at the same time do the out of the money put credit spread too? Or do you just do one side at a time?
Yeah, well, good point. And let me just say one thing, and Joe made a great point on the credit spreads. When is your most susceptible time to a gap? It's called earnings. So if I'm doing credit spreads on stocks, I want to be very careful, and usually I stay out of earnings because that's the potential for a big gap, and that's going to be a volatile environment. Generally, I personally don't. I mean, credit spreads are wonderful, and they can be used very effectively. A lot of people use them. I do more iron condors. Just as Joe said, if somebody starts with XYZs at 100 and they sell a 110 call and buy a 115 call, and they bring in $1 credit, their capital required at a brokerage firm is $400, the risk minus the credit to put that trade on. But for no more capital, right? It doesn't cost me any more capital. Actually, my margin goes down. I like to, especially in the indexes, I like to go on the other side. So if XYZ is at 100 and I sell one 110 call and buy one 115 call, I'll go to the put side and sell one 90 put and buy one 85 put. And maybe I bring in another $1, right? So now instead of bringing in $1, I'm bringing in $2 of credit. And instead of having $400 of risk, I only have $300 of risk. All right, so those are the pluses of this. So doing an iron condor, which is an out-of-the-money put credit spread and an out-of-the-money call credit spread, it has a couple advantages over a credit spread in that you're going to bring in more credit, and your margin or risk is going to be, your margin is going to be less. You're going to put up less capital because you're bringing in two credits. The negative of an iron condor over a credit spread is now I have risk in two directions instead of one. And a lot of people would rather have risk in one direction. I like the iron condors most of the time. But again, just like the credit spread, if I'm selling this iron condor in this example for $2 credit, it's going to be, without getting into a discussion of adjustments today, it's going to be a similar methodology to this credit spread that if I'm selling it for $2, when it goes against me, I need to buy this iron condor in at X price. I can't be losing that much more in my losing months than I make in my winning months. And I think that's the biggest challenge or obstacle that most iron condor traders or credit spread traders have historically come up against is they all do well when nothing's going on, but when it goes against them, because they don't have a plan, they get nailed. And again, iron condors would be more in a range-bound market versus credit spreads. You might have a little more directional opinion.
Dan, I got to tell you, we've been going at it here for over 35 minutes. And honestly, when we started Why World of Options about 2 years ago, the whole thought behind it was this very segment, Strategy Spotlight. I want to talk to option professionals who can talk in depth about a particular subject. And I just want to thank you. I mean, you talked about so much today in a very clear fashion: the covered call, the cash secure put, long diagonals, iron condors, the credit spread. Just great, great stuff. I hope our listeners appreciate it as much as I did. I just, and for you listeners, again, Dan, long time on the SIBO floor, and he's got his business, Sheridan Options Mentoring. Dan, thanks for joining us today on Strategy Spotlight.
Thanks so much, Joe. Appreciate it.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Laurie Itkin, financial advisor at Coastwise Capital Group and author of Every Woman Should Know Her Options. Laurie, thanks so much for joining us today.
Great to be here, Joe.
I think our listeners know that this month we're talking about income generation here at the OIC, and that is one of your specialties. Maybe before we get into the covered calls, why don't you let our listeners know about how you get into the business and what you've been doing?
Sure. Well, So as you mentioned, about 2 years ago, it's actually been 2.5 years ago, I published a book called Every Woman Should Know Her Options, Invest Your Way to Financial Empowerment. And it's really appropriate for people who have no investing experience and those who have some investing experience with stocks and mutual funds, and introducing them to the income generating option strategies. And it's been very well received. I mean, people are buying the book. They continue to buy the book. So that makes me feel happy. Good reviews on Amazon. Most of my time is spent being a financial advisor and wealth manager at Coastwise Capital Group. And although the stats show that more and more financial advisors are using options for certain clients, my clients tell me that they really aren't that many. And so I think we really differentiate ourselves for being covered call experts. And, in comparison, when you're looking for a financial advisor. And what I do that's also different from most financial advisors is for people who don't have a significant amount of assets. I do investment education, teaching them how to be their own money manager, and I introduce them to covered calls and the selling of cash secured puts.
Do you get any sleep?
Oh, yeah, 8 hours. I have to have 8 hours, Joe. I don't function. If I don't get 8 hours, I have to take a nap. So there you have it.
Well, I couldn't agree more with you in terms of the options being a differentiator there. So tell us a little bit about, why you personally got so involved and interested in options.
Well, what's not to love? I mean, it's just phenomenal. I first was introduced to options pricing as an undergraduate. I went to Wharton in the undergraduate program at University of Pennsylvania, and honestly, one of my favorite classes was options pricing, and I really liked it from a theoretical perspective. I never really thought I'd be investing or trading options, but it was always in the back of my mind. And there's been so much phenomenal education. All the major online brokerage firms do a lot about options education, and so it's just become something that is now much more accessible to smaller investors. And I became an expert in it, and I just love the flexibility that they provide investors. It's so much fun.
I couldn't agree more. And it's funny you used the word fun. I use that word frequently myself when presenting. It is a lot of fun. That option space is a living and breathing dynamic universe. And as you say, to get to be comfortable and somewhat expert in it is an awful lot of fun. How do you start with the underlyings first in your approach to investing and generating income?
Well, it's actually much more extensive analysis than that. I mean, let's say I have a client who I'm managing money for, we're going to, first of all, find out what their investment objective is. When do they need the money? Is this a long-term retirement account? Do they need money now to generate income? A lot of recently divorced women come to me and they need to generate income. We also want to know their tax situation, because as we all know, options are usually of a short-term nature, and so it's going to have a different tax impact than, let's say, dividends. So we need to know, are we investing in an IRA or a taxable account? And then we have to look at building a diversified portfolio. I personally like to use some individual stocks as well as ETFs to try to get global exposure, asset class exposure. As you know, some of the ETFs have options on them, some don't. And then in terms of selecting individual stocks, again, some of them will be appropriate for options with tight spreads, some won't. But I personally am like a Warren Buffett investor in terms of there's going to be a community of stocks. You look at the companies and they've consistently raised dividends over time. And for people who are really nervous about volatility in the market, I like to show them what happened in 2008 and which companies not only didn't cut their dividends, but increased their dividends in rough times. And that's going to give you a nice universe of stocks to start from for a core holding in your position, in your portfolio.
Indeed, it will. And when you then consider the covered call strategy, do you have a particular discipline, whether it's an at the money, an out of the money, a weekly option, a monthly option, a 3-month option? How do you approach that?
Yeah, that's why I love options. These tools provide so much flexibility. So for people who have really never worked with a professional to help invest their money, I have several clients, and they're nervous, they're risk averse. I'm going to do a lot of in the money and at the money calls because I don't mind if the stock is called away. All right, what I'm trying to do is generate income for them, and want to be more conservative. And we're talking about how April is income month, and with the Fed is not doing anything to help anybody generate income from bonds. So we have to use dividend paying stocks. We have to use options if you're trying to get some yield. And either you're a growth investor or you're an income investor, and you're going to be somewhere on that continuum at different stages in your life.
And if if the options expire and do not get assigned, again, is it a particular discipline to go back in and sell again, or do you pick your spots?
It just depends since I'm managing so many accounts and different sizes, I typically, for the accounts that I'm managing, are doing 2 to 3 month expirations. Rarely am I doing monthlies. In some cases, if it's a small account, it might be 6 months away expiration. And like this Friday, what's going to happen? I'm going to have a lot of stocks that are called away. I'm not rolling the option. They're so in the money now that I'm just going to let it get called away. And you look at it, if you hadn't sold a call on the stock and you sold it, you would have had a larger return than when you had hedged it. But overall, I don't mind that at all. And people get so wrapped around the axle, afraid that their stock's going to get called away, that you really have to look at the big picture. You made a nice return. And conversely, if the underlying falls a lot, you may want to just let that option expire. When I started doing options, I was a big roller, and now I'm less likely to roll because you have to really analyze the situation, and you don't want to blindly roll. The situation has changed, and you have to make a decision.
Sure. And one distinction you mentioned earlier was the whole idea of, a potential taxable event. And I'm sure that comes into play with your decisions there as well.
Unless it's an IRA. And then again, you have more flexibility. And I also, when we talk about IRAs, I love selling put options, especially on stocks or ETFs that don't pay dividends. Especially when you have some of the higher beta underlyings, more volatility, you can get some nice option premium when you're selling a put option, and you may or may not end up being put the stock. And it's just another great tool that I love using.
And so for our listeners who might be new to that idea of selling a put, when you sell the put, you collect whatever premium you take in for taking on the obligation to have to potentially buy that stock at the strike price. So I know there's a lot of fluidness in the space, but any particular discipline to whether you sell the at the money or out of the money put?
Yeah, usually, again, that's the phenomenon. This is a great question, because when I'm teaching people, this is when I'm giving investment education. I'm teaching people about selling puts, and of course, the big question is what strike price and what expiration. And this is why I love selling puts. I literally walk them through what is your return. What would your return be if you choose this strike price and it expires worthless? If you move up the strike price, you're taking more risk of having to buy the stock versus your return. And I literally, like, if we look at a 2 month out or 3 month out, we'll look at an annualized rate of return just for the theoretics. So you can see, and then they can make the decision how much risk they're going to take for the return. And it's a phenomenal teaching exercise.
And do you find that most investors are slow to pick that up? Do they embrace it in a hurry, or does it just depend?
Well, so it's interesting because I have lots of different clients from all different disciplines. When I talk about the clients where I'm educating them, I have found people that you wouldn't think would get this, and the people you think would get it don't get it. And it's just like anything else, right?
Yeah.
And really like to, if people are getting confused on covered calls, they often do, I will just focus on getting them comfortable with selling puts because I think it's a much easier thing to grasp.
And of course, don't forget to tell them to always come to the OIC for options education.
Absolutely. Absolutely. Free
Well,
education. It's terrific.
amen. Well, it's, again, our theme this month is income generation. I'm very pleased that you're able to, make time in your day to talk to our listeners about this. It's the covered call, it's selling puts. It is a solid fundamental way to generate income. Any closing words for our listeners?
Sure. People often think that options are very risky and they get very scared. These two strategies are less risky than just buying stocks on your own. So people need to remember that options can be used in a way to generate or create less risk. They're known as hedging, and don't be afraid. Come learn. You will love what you've learned and use it for the rest of your life.
Great, words of wisdom there, Laurie. Thank you so much, and look forward to having you back on again in the near future.
Thanks, Joe.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we'll start with a couple of tools I mentioned in our Looking Back segment. Do check out the OIC Covered Call Calculator, as well as the historic and implied volatility charts. Both will be found on the OIC homepage below Tools and Resource drop-down bar. The new resource I'd like to make you aware of today are OIC Quick Guide videos. These short 3-minute videos cover one option strategy at a time. Currently, we've released 3: the protective put, the long call, and the covered call. You'll find these at optionseducation.org/tools/video-series. That's optionseducation.org/tools/video-series. We'll be releasing a total of 20 of these videos throughout 2016. As for today's good read, I'd like to offer 2 authors for you to check out. The first is Dr. Alan Ellman. That's Alan Ellman, E-L-L-M-A-N. Alan's company is the Blue Collar Investor, and he specializes in covered call writing. He's authored 6 different books. The other author, and actually a guest on Profiles and Perspectives this month, is Laurie Itkin. Her book focuses on covered calls as well, and is titled Every Woman Should Know Her Options. Invest Your Way to Financial Empowerment. Again, the theme this month for OIC education is income generation. Both these authors specialize in that, and I hope you'll check them out. Lots to consider. Glad you joined us on today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, and within our theme of income generation this month at OIC, I thought I'd review high volatility periods in our markets over the past 10 years and talk about the impact on covered call returns in a very general sense. Let's start by defining the high volatility periods. Number 1, and of course the most volatile period in the past 10 years, and well beyond that, for that matter, is the 2008-2009 financial crisis. In VIX terms, and VIX is the 30-day expected implied volatility for the S&P 500, implied vols got to a range in the 80s, extraordinarily high, and that was in 2008. VIX didn't exist in 1987 for the crash in October of that year, but on a calculated basis, VIX got to the 140 range in October of 87, the only time it was as high as the 08-09 period when, again, the VIX got to 80. One more point. The markets declined in Dow terms about 50% from all-time highs during the 08-09 crisis. Now, the second most volatile period, and a distant second, although it didn't seem that way when it was happening, was the summer of 2011. That's the time when the U.S. lost its AAA credit rating. The markets declined close to 20%, and the VIX climbed to about 45, another very high level historically. Two other periods to highlight quickly are the fall of 2015 and the start of 2016. In Dow terms, the markets pulled back about 12% in both instances, and the VIX moved up into the mid to high 20 range. So what do these implied volatility levels have to do with income generation using options, specifically covered calls? Well, options have two pricing components: intrinsic value, the in-the-money amount, if there is any, and time value. The time value component of an option expands and contracts as stocks, indexes, and ETFs move. Typically, as markets fall, time premiums increase, so returns from the covered call strategy will improve when option premiums expand. That's not to say chasing returns is the way to approach the covered call strategy. Just know, as markets decline, covered call returns will likely increase. Remember, the risk in the covered call is the long underlying position below a clearly defined break-even point. Calculating the break-even is easy. Take the underlying price paid minus the call premium received. Of course, the call premium is dependent on the strike price sold and the period of time to expiration. It makes sense to employ covered call strategies on stocks, indexes, and ETFs that you're comfortable with. A couple of resources you should be aware of when employing the covered call strategy, and actually two of my favorites, both found on the OIC website at optionseducation.org under the Tools and Resource drop-down bar, are the historical and implied volatility charts, along with the covered call calculator. Please take the time to check them out. You'll be amazed at how much you can learn. As always, if you have questions, either send them to us at options@theocc.com or reach out to our friends at OIN, the Options Insider Network. Thanks for joining us today on Looking Back.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.